It's a guy Manny coming to you live from my little home office here in San Francisco. Now, guys, I've wanted to do one of these investing videos for a while, and I thought, what better time to kick it off than the earnings season? Netflix just reported earnings today, one of the Max 7s. So that's my first project, a provision of my analysis thesis about Netflix and the space. Know that this is not financial advice. So just want to make that very, very clear. It's going to be my recommendation of the stock in the space. And at the end of the video, I'll help you come up with a buy, sell, or a hold recommendation. Now, a little bit about me. I'm a finance leader from the technology sector, and I'm a retail investor, growth-focused retail investor. So I like to dabble into cryptos and stocks predominantly. And so with that, let's get into it. Also walk you through some of the data sources I use. This is TradingView, which I use a lot. This is a chart of the S&P 500 index. Netflix is obviously one of them. On the 5-day chart, the S&P was having a stellar week. It started off on Friday ended at 5615, had a strong open, and they kind of carried through to the end of Tuesday at a price of 5.6667. And then at some point there, Biden and Trump both said things that were anti-China and anti-Taiwan. And because of the fact that the manufacturing of the semi space or the semiconductor space happens in these countries, those stocks fell, and that took the entire index down because of the heavy weightage that semis and the overall AI sector carries on the S&P index. And so somewhere down this point on Wednesday, we were all hoping for TSMC to report great earnings, which is based in Taiwan. And they did report great earnings, but lack of faith, and there was continued sell-off today. And today's sell-off was very dramatic. It actually took the other index, which is a small cap index, the IWM, down as well. And so we're currently at, I think, 5,500 on the S&P, which is not bad from an overall perspective. If you look at the 1-year chart, we're still sort of, very close to all-time highs, but really lost the momentum that was building. Now, that's a good and bad thing. As you head into earnings, a lot of times investors take their position or reposition themselves ahead of the earnings. So, but that's essentially what happened. So now let's get into the next topic, which is now that we understand the weekly context, let's get into kind of Netflix's earnings. I've got the income statement, the balance sheet, and the cash flow. So from an income statement perspective, Netflix reported $9.6 billion as their revenue. This compared to 9491 as their revenue, and their operating income is 2520, so $2.5 billion. Instead, they came in at 9.559 and $2.6 billion. So they overshot their revenue and their operating income, which is honestly not of a big surprise to me. They've done this many quarters in the past. But if you look at the deltas between the quarters, so number one, on an operating front, there was really nothing there. Their revenue went up, and their cost of revenue also went up. And at the end of the day, on an operating income perspective, they were pretty much flat. And they'd said that at the end of Q1 for Q2. So the real movers really were on a non-operating perspective. I like to look at these ratios as well. So gross profit margin, as you see, has been steadily increasing. In Q1 and Q2, they're significantly up. So margin has expanded significantly. And one of the biggest drivers for the operating income, the other driver being operating expenses. So that's a bit on the income statement. If we switch to the balance sheet view, I mean, there's a bunch of ratios you can look at. You can look at current assets, on a liquidity, on a solvency perspective. I look at debt to equity. So debt to equity is critical because that helps you understand their cost of capital. So the debt to equity has been around the 70s in 2022, then the 60s in 2023, and Q2 was 55%. So huge improvement from that standpoint. Their cash is at $6.6 billion. So they're definitely not short of a dime. But I don't think there's anything to worry about from a liquidity or a solvency perspective. From a cash flow perspective, that was the biggest change. So the operating cash flow between the quarters reduced by 900 million, so almost $1 billion. And we walked through the puts and takes on the income statement between Q1 and Q2. But the other drivers were additions to content assets, which increased between Q1 and Q2. Now, what are content assets? Content assets for Netflix are really the total gross additions to streaming content assets, not the cash paid. Now that's because it's of a fixed nature. So Netflix basically pays a fixed fee for a window of availability, and that basically went up. That went up, and content liabilities also went up. So they were the two other drivers other than net income differential. And then you had a difference in accrued expenses and other liability. A lot on the cash flow statement is also to do with timing. So suspect that there's a whole lot of timing going on, especially in this line. And then there's another one on the deferred income tax. Netflix ended up with operating cash flow of $1.3 billion, which is 900 million of difference. Netflix's Q2 report. So there are a bunch of great shows. They talk about their approach to their ad business. I think the ad business is very critical to growing their operating income and their revenue. And I think one of the most interesting charts for me was this one, the engagement and competition. And so they say this is the Nielsen's gauge of the share of U.S. TV screen time, and Netflix is at 8.4, YouTube is at 9.9. So those are the key takeaways for me. The direct competitor is Prime Video, HBO, Hulu, and those are significantly low. So this goes to show that Netflix is hands down a leader in this space. And then they've got games as well, which is coming up. I think in Q4 they're going to have the NFL games that's going to be streaming live, um, and all that will bring more advertising, more time spent on the platform, so on and so forth. Comparison standpoint. So how does Netflix's share price, the price that you're paying for that stock, compare against a benchmark? And so two benchmarks that I like to look at. One is the entertainment sector. I like to, in this one, compare them to Spotify, which is also a streaming service. Disney. Look at this. Spotify is also one of the, I guess, the only alternative of that size and the kind of things it provides, and a premium security. They're trading at a forward ratio of 39x. So they're asking for their price to earnings per share. So stock price divided by earnings per share is trading at 39 times. Their PEG ratio, which is price versus growth, is at 0.53, which is a great thing. So comparatively, Netflix is trading at 28.7, so it's cheaper than Spotify. If I wanted to set that context, versus Disney, who's I'd say in the video streaming sector is definitely not doing as well as Netflix is, and that's reflected in their share price, which is trading at 17 times of a multiple. I think if you ignore Nvidia and call it an outlier because of whatever is happening, and Tesla, I just like to exclude Tesla from every analysis from a benchmarking standpoint. But if you look at Microsoft, if you look at Apple, Meta, Netflix, and then Google. Netflix is somewhere in the middle. And what is fundamental analysis? A fundamental analysis is the calculation of an investment opportunity discounted back to today. Formula is your operating cash flow minus any capital expenditures that you would spend on an ongoing basis. I'll continue to present a fundamental analysis in the securities that I present or I opine on. But so this is my calculation. So and then I make my I make a judgment of where the revenues and the cash flow profile is going to go from here on. Netflix is guided to in their report. So in their Q2 report, if you go right at the top, which is up from 13 to 15. So essentially, they tightened the range, but also upped the range, and so that gets us at $38.6 billion, which is a 14.5% improvement over the last year. So I'm just going to talk about the calculation very quickly. So um, their margins have expanded. So I'm using that as my assumption in that they will continue to expand margins. But given the fact that they're already at 46%, I'm using a 50 basis points or 0.5% improvement year on year. I say that, I've seen operating expense improvement. So as you grow your revenues, your operating expenses don't need to grow in that exact same proportion. They will scale. That's what scaling means. And therefore, you'll achieve an improvement of 25 basis points. So I'm being very conservative there. And that's how we get to the operating income. And then I say, okay, you will invest in your business according to your past history. And I get to a free cash flow number of $6.8 billion. So I'm saying that based on my conservative assumptions, that they will overshoot their free cash flow number. So I say that they'll achieve $6.8 billion. And then I'm assuming a kind of a trajectory going forward. And then the way this fundamental analysis works is that there's year one, year zero to year five, and then there's a terminal value, which is essentially saying using an average weighted average cost of capital of 8%, um, in perpetuity. At that point, it's going to be worth $400 billion or $400 billion of free cash flow. The market is also, now this is based on my research, the market is in 2024 worth 108.5 billion dollars, out of which Netflix represents a 35.6% market share. This is vetted by from the source that I've received, and this assumes that Netflix's market share is going to go up slightly. So let me do this NPV calculation live. So I go NPV 8% as the discount rate, comma, and then I just do that divided by that. And then I get to a price of $630. So that's my fundamental analysis, guys. This is Netflix's 1 year chart. This is the Fibonacci retracement tool that I use as one of the indicators. So my first gauge looking at this is that from a technical perspective, things don't look great. I wouldn't, if it were my money, would I buy Netflix stock tonight? No. Would I wait for a jump? Yes. Do I still believe in Netflix's stock? Yes. Do I think the stock is worth the current price? Yes. At this point, investors are taking profits, and this is not new. Earnings are coming up. They don't know what Netflix is going to say, especially given the fact that in Q1 the stock dropped after earnings. And recently is also the what's happened on the S&P index, from a semi space or semiconductor space. Thank you to Biden and Trump on that note has kind of seeped into Netflix, and therefore the stock's down today after the good earnings report and the increasing of their forecast. In short, technical analysis doesn't really paint the best picture. If it does cross below this line, which is the 637.25 line, I'd be worried, and I'd be definitely waiting for the next opportunity to get back in. So that's it here from our home office in San Francisco. I'd say Netflix is one to watch for sure. I wouldn't really necessarily give it a buy recommendation today, but I definitely say it is one to buy for the long run at the right price. And I think that it's at a fairly good price. It's still at it's very close to its fundamental value, although the technicals don't really say that it's a buy. If you have Netflix, I'd say obviously judge it versus your own investing objectives. I wouldn't say selling it is a great option right now either. Just given the fact that the overall S&P and the chip sector is weighing on these securities. So bye for now. See you guys next time for another topic and another security. See you later.